Hi, everyone. Jared Herridge with the Associated Builders and Contractors of Iowa. Thank you so much for taking the time and being on the webinar here with us today. Cody Edwards with the Dickinson law firm will be presenting today. We actually did this seminar back in January, I believe. Had a very, very good turnout and some very, very good Q&A questions and answers for Cody during this process. As we roll along here, if you do have a question, go ahead and in your right-hand corner, you'll see where you can type the questions. Go ahead and type those in, and once we do see those come up, Cody will be able to answer those as they come in. Any other questions you have after the presentation, go ahead and email Cody. He will give you all his information here shortly, or reach out to me, Jared with ABC of Iowa, and I'll be glad to answer any and all of your questions. Further ado, Cody, go ahead and take it over, sir.
All right, thanks, Jared. Like Jared said, I'm an attorney with the Dickinson law firm, and today I wanted to talk about sales and use tax for contractors in Iowa specifically. I called it Into the Abyss because, as many of you guys likely know, since you're attending this webinar, it seems like it's a never-ending black hole of rules and exemptions and exceptions to those rules for contractors in Iowa. Now, I'm going to try to answer your questions today, but there's still going to be some questions after this webinar. So, as Jared said, feel free to call or email me, and I can help you out as much as possible. So that's my contact information. Feel free to call me, email me. A little bit about myself and why I am talking to you and why you should trust what I'm saying. I've been in this state and local tax practice area since I graduated from law school. My first job out of law school was with the Iowa Department of Revenue. When I was there, I worked on a wide range of matters, primarily sales and use tax, did some income tax as well, and property tax. Currently at Dickinson Law Firm, where I lead the state and local tax practice. In that practice, I provide general state and local tax guidance to clients, and one of my favorite things is to help clients when they get audited by the Department of Revenue. As we'll see here, a lot of times it's contractors, but a lot of times it's also individuals. I generally like to start my presentations with a joke. So today, when I was preparing for this presentation, I scoured the internet for a sales and use tax joke. And it may not surprise you that there are apparently no sales and use tax jokes. So maybe that is the joke right there. All right, so let's start with the agenda. We're going to start with Iowa sales and use tax basics, taxation of new construction and repairs, common audit issues, and the new law. I'd say it's relatively new, and it's about a year and a half old, affecting manufacturers. And after the last presentation, people wanted to know about contracts with exempt entities, and I'll also provide just some guidance on general sales tax issues affecting every business in the state. Like Jared said, you can ask questions during or after, and I will try to cover those either as they come in or if they don't fit within what I'm talking about at the very end. All right, Iowa sales and use tax basics. Sales tax. Sales tax is what you pay or what you must charge when you buy tangible property or services. As we'll see, contractors are generally considered the consumers of tangible property, so they're not charging tax, but they generally must pay sales tax. In Iowa, if you purchase tangible property, it's subject to sales tax unless there's an exemption. Now, Iowa Code 423.3 is where your exemptions are listed, and there's over 100 exemptions, and in a lot of those cases, those exemptions have exceptions to the rules. So relevant to contractors is the manufacturing exemption. That exemption covers machinery and equipment, and it's actually quite broad and covers more than machinery and equipment, and I'll talk about that a little later. Farmers get a nice exemption, and we'll talk about this one later as well. Everybody's favorite topic of grain bins and computers. Computers used by a commercial enterprise in Iowa are exempt. So let's talk a bit about the computer exemption real quick. This applies to contractors who purchase computers to use in their office. And the computer exemption applies to your standard computers, what you would think of, but also the monitors and anything else that would be attached. So scanners, printers, things like that. Now, that might be obvious, but the computer exemption is even more broad than that. In 2010, a court case came down and it held that slot machines are computers for the purpose of this exemption. Like I said, there are exceptions to these exemptions. So these slot machines were computers, but they were not exempt from tax because there's this exception for point of sale equipment. Now, I say all that just to show you that the computer exemption is very broad. So that applies to iPads, phones, and I've even joked recently that the Tesla that you just bought might be considered a computer because it processes data. Any questions on that computer exemption, let me know. That's a really fun exemption just to think of, all right, where is technology going? Where has it gone? And what could be considered a computer? And it may apply to some of your construction equipment as well. All right, services. Services are subject to tax in Iowa only if they're enumerated. So within these enumerated services include repairs of all kind. So that's very applicable to contractors, but it also includes Turkish baths and reducing salons. Now, as a young guy, or I should say relatively young guy, I don't know what a Turkish bath or a reducing salon is, but that tells you how old these laws are imposing tax on a service. One thing that might be of note to contractors is the legislature is trying to fill this budget gap, this fiscal issue that we're having, and one way of doing that is they're considering expanding the list of of services. One thing they have considered is taxing the service of architects and engineering services. So something to keep in mind. Of course, it's very early in the legislative session, but those two services have come up on the list of services that may be subject to tax. Luckily, attorneys and accountants have been spared from that list. Okay, use tax. Everybody's favorite topic, and what I like to refer to as the elephant in the room, because everybody knows what it is and knows that it's there, but they don't want to talk about it. Use tax is the tax imposed if you should have been charged sales tax, but it wasn't charged. So the best example of this are your Amazon purchases. That may change, but a lot of the times Amazon doesn't charge you tax, but you're supposed to pay use tax on it. Another instance would be services. Services are gray with respect to if they're taxable or not, but if they provide a repair service and they didn't think it was a repair, they thought it was a new construction and they didn't charge you tax, then you may owe use tax on that. For contractors, there are really two ways to report use tax, and contractors are unique in this sense in that the code allows for contractors to remit use tax on the sales tax return. There's a goods consumed line on there, and the rules allow the contractors to report use tax on that line, or they can file a separate use tax return. Iowa is odd in the sense that it has two different forms for sales and use tax, and this really matters at the end of the day due to the statute of limitations. If you do not file a sales or use tax return, the Department of Revenue can audit you for unlimited amount of time. So they can look back an unlimited amount of time and audit your purchases and see if you have any sales or use tax liability. For practical purposes, that means 10 years, but that number really adds up if you're audited for 10 years and the Department of Revenue finds a mistake. If you do file a return, that's 3 years. And the question, and I'll get into this later, is does filing on that goods consumed line, does that start the statute of limitations? And this issue has not yet been resolved, and I think it's maybe working its way to get resolved right now. But that is really the $1 million question, is whether that goods consumed line starts the statute of limitations for use tax. Like I said before, there are many exceptions to these rules for contractors. Contractors are the consumers of goods, and they can't resell them, and services used in connection with new construction are exempt. I'll get into that a little bit later. Separate sales and use tax return, I should point out, I recommend filing both, even if you're filling in that goods consumed line. Like I said, we've had this fight with the Department of Revenue about whether that goods consumed line starts the statute of limitations, but it's safer if you're filing both the sales and use tax return, even if your use tax return is a zero return, where you merely submit it with a zero on there. That being said, if you're not filing a use tax return, I would highly recommend not just filing the use tax return straight out. There's a way you can really control the audit process. It's likely if you're filing a use tax return, they're going to look at your sales tax return. If you've been filing a sales tax return for 20 years, that's a red flag. So by filing a use tax return straight away, that can read a red flag and an audit, likely on a 10-year audit. So we can do something called a voluntary disclosure agreement, where we would anonymously contact the Department of Revenue and say, my client just figured out they weren't in compliance with the law. We want to come into compliance and file our use tax returns. What that does, that limits the look back period to half time, so 5 years, and they waive penalty and interest. So if you're not filing use tax returns, strongly consider a voluntary disclosure agreement before you file. All right, let's get into the meat of this. Contractor versus contractor retailer. This is the decision that is or has been made when the contractor or contractor retailer initially started doing business. And this is important because it affects how you pay tax. So for a contractor primarily performs construction work, and they're considered consumers of the building materials and supplies, and they must pay sales tax on the building materials and supplies when they're purchased. Now, compare this with the contractor retailer. The contractor retailer makes frequent over-the-counter sales and performs construction work. They purchase building materials and supplies exempt for resale, and they pay tax on the cost of items when used in performance of the construction contract. With respect to the third bullet point on the contractor retailer, this payment should be on the goods consumed line. You could pay it on the use tax return, but technically it should be on the goods consumed line. And the key here really is to be consistent. An issue I've run into recently, and may run into in the near future, is what happens if your business evolves. So say you start out as a contractor retailer, you provide over-the-counter sales, and then you may, like once or twice a year install a building. You're obviously a contractor retailer, but let's say that evolves and your primary. The webinar you have entered primarily a contractor. If you switch to a contractor, sorry about that. If you're primarily a contractor, then you purchase all your building materials and pay tax on them. Now I'll give you an example here, and I don't mean to scare you, but this kind of shows you what can happen if you do not reevaluate your business regularly. Had a client who was initially a contractor retailer, so he purchased everything exempt for resale, and then when on the back end he actually charged sales tax even when he was installing the building materials, and he was charging tax on even the marked up price of the building materials. So he did that for a while, and that was when he was primarily a contractor retailer. And then his work evolved to he was a contractor, and he continued to do that. The Department of Revenue came in and said, well, you no longer have your contractor retailer hat on, and you should have paid sales tax on all those building materials. They audited him for 10 years. There's another issue of whether they should have audited him for 10 years. And they audited him and dinged him for all the tax that he actually passed on to his customers. So the state got their money on the marked up price, but they said, well, you got it from the wrong person. So the amount at issue here is, $1 to $2 million worth of sales tax, which is obviously a huge number. But I think we're working through the issues, but that's something to keep in mind on why you should reevaluate your purchasing methods and your business model. If you have evolved into a contractor, you should certainly consider changing your purchasing methods. All right, this is building materials and supplies. These are taxable when you install them. Building materials, tangible personal property that becomes attached to, incorporated, or part of the real property. You see the examples there. And then supplies, they're taxable as well. This next slide is a good slide to look at if you're doing business in more than one state. So let's say you have a location in South Dakota and a location in Iowa, and the building materials were purchased and delivered to South Dakota. If you properly paid tax in South Dakota, then Iowa will give you a credit for the tax paid in that other state. So South Dakota's tax rate is 4%, Iowa's is 6%. Iowa will give you credit for that 4%, but you're still on the hook for that 2%, the difference between Iowa and South Dakota. The key here is that the tax has to be properly paid to the other state. And that's a big key, and it shouldn't be a huge issue. Most states are similar to Iowa in that contractors are consumers of building materials. So if it's delivered in South Dakota, you're likely going to pay sales tax on it. Building materials brought in or delivered to Iowa and used outside of Iowa. Contractors' purchase of materials in Iowa used outside of Iowa is subject to Iowa sales tax. And that makes sense because the contractor is putting them in their inventory for consumption in Iowa and then taking them to the other state. The other state will and should give you a credit for the Iowa tax paid. So to the extent that the other state's sales tax rate is higher than Iowa's, you'll only have to pay that difference. Or if the other state is sales tax rate is less than Iowa, then you don't owe the difference in the other state. Contractor retailer treated a bit differently here. Their purchase of materials in Iowa for use outside of Iowa is not subject to Iowa sales tax. And again, this makes sense because you put in your inventory for resale, and then you can say that you've essentially resold them to yourself in the other state. Keep in mind here that if you purchase them, if you're a contractor retailer in Iowa, and use them in the other state, then you likely owe the other state's full rate. This is a very useful in making the distinction between new construction and repairs. And as you know, this is not an easy task to determine the difference between new construction and repairs. And the code, of course, is very helpful here. And it says new construction is reconstruction, alteration, expansion, or remodeling of real property. When we look at repairs, you'll notice, well, what the heck is the difference between remodeling and repair, and to what extent do we have to do work to make it remodeling and not a repair? And, you know, it's facts and circumstances at the end of the day. New construction does not include electrical installation, plumbing, and pipe fitting. Here's another exemption, unless it's performed in connection with new construction. Examples of new construction: build or add to a building, move, remove, add a wall, replace an entire roof, add a deck to existing structure, and install new fencing, retaining wall, and ponds. As we'll see, if you replace an entire roof, that's considered new construction. But if you replace a portion of the roof, that's repair. Same thing with the deck. If you replace a couple boards, that's repair. But if you add on an entire deck or replace an entire deck, that should be new construction. Generally speaking, if there's a structural change, that can be considered new construction. And my tip of the day, or my tip for this slide, is your invoice should really reflect keywords and match your taxation. So if you're not charging tax, you can say, we reconstructed the house, or we altered the wall, or we expanded the deck, or we remodeled the kitchen. And a lot of the times, if you put those buzzwords on your invoices and they match your taxation of new construction, zero tax, then the Department of Revenue shouldn't have an issue with that in the case of an audit. All right, repairs, I touched on this a bit. To mend, restore, maintain, replace, and service something that has become imperfect. The examples I've already touched on. One thing to note, repairs after a fire, flood, tornadoes, any sort of natural disaster are not taxable. So even though it would be a repair because you're replacing or you're repairing something that has become imperfect, it's not taxable. Again, that's another exception to the rule. Again, invoice should reflect this. So replace carpeting after a flood, or something like that, so the Department of Revenue really knows what is going on. I think I've already hit on this, but taxation of new construction and repairs. This is important enough. We're here to learn about sales and use tax, so I might as well beat this one up a bit. And we break it into contractors and contractor retailers. New construction and repairs by contractors. New construction tax should not be charged on materials or labors on new construction contracts performed by contractors. So you can do lump sum billing if it's new construction and not charge tax. Keep in mind, if as a contractor, you should pay tax on the materials that you're using. Repairs, tax should be charged on labor performed by a contractor. Tax should be charged on materials as well. And this is key. If you separately itemize materials and labor, you can take a credit for the tax paid when you initially purchase the materials. If you bundle them, you don't get a credit. So the key here is separately itemize your material and labor. Taxation of construction repairs by contractor retailers. New construction tax should not be charged again. Labor and materials are exempt new construction. But as a contractor retailer, since you purchase your building materials exempt when you brought them into your inventory, you need to pay tax on them when used in new construction. So again, ideally, this is paid on the goods consumed line. You could pay it on the use tax line, but goods consumed is cleaner. And again, consistency is key here. Repairs, tax should be charged on repairs and materials used in the repair. There's really no need to separately itemize the materials from labor here, because think back to contractors, the reason we did that was so we could get the credit of the tax we already paid on our materials. So if you're a contractor retailer, you don't need to separately itemize your repairs. Services subject to tax. Like I said, only enumerated services are subject to tax. These are the ones relevant to contractors. I would like to point out that the Iowa legislature, in its infinite wisdom, has said that lawn mowing is a taxable service, but snow removal is not. And I have seen this as a big audit issue, actually. You know, the kind of lawn mowing and snow removal services go together. So one is taxable, one is not. Services in connection with new construction are exempt. So again, facts and circumstances depend what is in connection with new construction, and examples are excavating, grading prior to a construction would be exempt. Wiring of new machinery during a remodel, that would be exempt if it's even if it's not in new construction, actually, because it's the manufacturing includes an exemption for services used in manufacturing. What would not be in connection with is the replacement of a broken window in the kitchen while the bathroom is being remodeled. Apparently, that's too far removed from the new construction to be exempt. Generally speaking, the larger in time from new construction and the services, the less likely it's in connection with. So an example might be you build a house, it's done in the spring, and then you wait until the next year to landscape your yard. Likely not in connection with new construction, and landscaping is a taxable service, so tax should likely be charged. I think this is a good spot to talk about construction contracts with exempt entities. And there are two types of exempt entities that you may deal with. One is what's called a designated exempt entity, and I think there are about 12 entities that are considered designated exempt entities. And these entities are the only ones that can register their contracts with the Iowa Department of Revenue, and that can hand their exemption certificate to the contractor, which the contractor can then pass on to its suppliers and purchase the materials exempt from sales tax. Designated exempt entities are the big ones: nonprofit, private schools, museums, governments, and those are the ones they're generally pretty good about pre-registering. But that's something you can ask for prior to entering into the contract and prior to purchasing their materials. The other ones are the other exempt entities are those that are getting economic incentives. A lot of times the economic incentives are sales tax exemption for the building materials, and those have to go through a different process. They have to get a contractor statement from the contractor showing all the building materials and services that were purchased by the contractor and all the sales tax that was paid. The contractor then gives that to the entity, and then the entity files for a refund with the Department of Revenue. Your designated exempt entities may have to go through this process if they forgot to they forgot to register their contract, but a lot of times the exempt entities are pretty good about that. Installation of machinery and equipment. So we have a contractor, they're building something, and then they also install machinery and equipment, or they install machinery and equipment. They have to wear two hats here. They're a retailer of the machinery and equipment, and they are the installer of the building materials. So they need to purchase the building materials with sales tax. Don't charge sales tax on the construction contract, but they purchase the machinery and equipment exempt for resale, and they sell that equipment to the end user. The flow of this, the contractor gives the resale exemption to the supplier of the machinery and equipment, and then depending on whether the ultimate consumer is an exempt entity, probably a manufacturer, they have to take a exemption certificate from the manufacturer. I think the baseline here is to protect yourself and always charge tax on machinery and equipment unless they give you a completed exemption certificate. The key here, one of the keys is the exemption certificate has to be taken in good faith, and the exemption certificate has to be completely filled out. So an example would be somebody going into Best Buy and buying a TV and giving them an exemption certificate. Best Buy, should scrutinize that a little bit and say, all right, what is your reason for this exemption? And that's kind of your good faith requirement. But a lot of times if contractors are installing with manufacturers, it's pretty clear that it should be exempt. And fully completed exemption certificate, just make sure everything is filled out, including the reason for the exemption. There's a line that says other, so if they don't check one of the other boxes, you need to have them give you a description of why the machinery equipment should be exempt. This slide here essentially is just talking about how contractors cannot pass on exemption certificates. So the manufacturer cannot give the general an exemption certificate and then the general give the manufacturer's exemption certificate to the sub. Each level has to give the prior level their own exemption certificate. So subcontractor purchases a lathe, and they're going to resell it to the general contractor. They give the supplier of the lathe a resale certificate. If they sell it to the general then has to give another resale certificate of its own to the sub, and then the manufacturer gives an exemption certificate of its own to the general. So the manufacturer cannot just pass the exemption certificate to the sub. This is different than some states in where you can have the manufacturer give everybody their own exemption certificate, and it can kind of flow through to each of them. Okay. This is, I understand this is a terrible slide because all of the words on here, but this is also a very confused area of the law, so I thought that I would spell it out in the slides. Basically, Iowa has two set of taxes for heavy equipment used by contractors. One's a 5% excise tax under 423D, and 6 is a 6 or 7% sales tax under the sales tax code. And they're treated differently depending on who you are and what the use is. The focus here is on new construction, but the bottom line is purchases of self-propelled building equipment for resale or lease are exempt from the 5 and 6% tax if used in new construction. Rentals of the same equipment are exempt from the 5 and 6% as well. So your tax planning opportunity here is to set up a separate entity to purchase equipment, and then you would subsequently lease to your construction entity, and this would save you the 5 or 6%, or I guess 7% if you're in a local option jurisdiction. That would save you that percentage of tax on the heavy equipment, and this is used in new construction. Now, I want to caveat this a bit in that the Department of Revenue is currently auditing on this issue. Now, I don't want to scare you. I think we have relatively solid basis for not paying tax in certain circumstances, but I wanted to point this out, and it helps if you know the history. I'll be brief here. In 2008, Iowa adopted a whole new sales tax regime called the Streamlined Sales Tax Agreement, and in doing this, they removed and added the 5% excise tax to this heavy equipment. What they didn't plan on, or what they didn't think about, or what they didn't catch within this change was that adding this new provision for the 5% excise tax effectively repealed both the 5 and the 6% tax. Now, no one knew that, and this tax was being collected for 6 years up until 2014, when the Iowa legislature figured out that they've been collecting this tax erroneously for 6 years. So in 2014, the legislature retroactively 6 years corrected, and I'm using air quotes here, corrected this mistake. So here we are now, and the department is currently saying, well, we've put you guys on notice since 2014, so we're going to come back and audit on this issue. I don't know if it's a widespread audit yet, but I know of one equipment dealer who's currently under audit. And the department's position is really that equipment dealers can purchase this equipment for their rental fleet, exempt if they're going to subsequently lease it, if they're going to lease it for new construction. But once the dealer rents it for repair or for a purpose that's not new construction, then that triggers tax due on the purchase for the dealer. Now, this is completely wrong, and I don't know what stage this audit is in yet, but you can certainly send me an email, and I can give you updates on this as I catch wind of it. Not to scare you, I think we're on pretty good ground here, but it's maybe something the Department of Revenue is trying to take on, maybe trying to fill that budget. All right, common audit issues. Failure to charge tax on labor. This is what we talked about a bit earlier. The distinction between repair and new construction. The department says, we'll look at an invoice, say, well, this is taxable repair. Taxpayer's response, no, this is non-taxable new construction. Negotiate that enough, you may settle in the middle or get it taken off. Second issue, contractor purchasing building materials for resale and charging customers tax on the building materials. Again, I hit on this one earlier. The department says, hey, contractor, you're acting as a contractor and should have paid tax on your purchases. And then they audit the contractor for use tax, oftentimes 10 years. Taxpayer's response, contractor is a contractor retailer, and they purchase the building material for resale. And the department is double dipping. I'm a Seinfeld fan, so I wrote a blog about this. Seinfeld and the Iowa Department of Revenue, we'll say the Department of Revenue is kind of like George Costanza, the double dip. The issue here is really that the Department of Revenue is getting more tax than they should have, right? So the contractor is not paying tax on the cost of materials, and as you know, your cost is less than your marked up price. So the department's getting, well, let's call it 1.3 times the amount of sales tax they should have, assuming your markup's a 0.3. The other issue here, it's kind of an equitable issue, is that the department says, hey, contractor, you charge this tax to the end consumer, and they shouldn't have paid the tax. You were not double dipping because the customer can go back and they can file for a refund claim. Now, the issues here are that they're going to audit the contractor for 10 years usually, and the statute of limitations for the refund for the consumer is 3. So the department then is getting 7 years of double taxation, more than double taxation. And a lot of the times, by the time this comes to a head, the customer is precluded from the 3-year statute of limitations from filing the refund. So it's just more of an equitable argument. There are certainly some legal arguments to be made, but it's just not a good policy in my opinion. Failure to file use tax returns. I think I've beaten this one up enough, but it's really contractors are allowed to file the use tax return on their sales tax return. So as long as they're filing a sales tax return, they should be starting the use tax return statute of limitations as well. Grain bins. I'll talk about this one. It's everybody's favorite topic. Feel free to call me to talk about this one. It's typical Saturday morning conversation for me and my friends. Grain bins, real or tangible personal property. Department says grain bins are real property. See the administrative rule, and the contractor should have paid tax on the cost of the bins. We've actually confirmed that this continues to be the Department of Revenue's position, but I'm not convinced that it's a great position. The first thing is it really tangible property, or is it real? As far as I can tell, there's a market for used grain bins, and that's a pretty good indication that they can be separated from real property and then remain tangible personal property. The rule that the Department of Revenue cites to is illustrative, and the department's 2016 administrative rules clarify what the rules have always been. So in 2016, the manufacturers in Iowa had been pushing for the manufacturing exemption for supplies for a very long time. The legislature said it wasn't going to take that issue up, so somebody submitted a petition for rulemaking and submitted all these rules to really change what the law was of supplies being exempt. Now, I don't know who stuck this other portion in there, but the other portion of the rules redefined grain bins as tangible personal property. But in proposing these rules, a lot of people were complaining that this was changing the law. Supplies are not exempt under the statute. The Department of Revenue came out numerous times in public statements and said, we're just clarifying what the rule always has been. We're clarifying what the law always has been. And if the law has always been that grain bins are tangible personal property, then I'm not sure how the Department of Revenue can take the position that they're real property. 2016, the administrative rules were repealed by legislation, and then the Department of Revenue wrote new administrative rules but took out the redefining of grain bins as tangible personal property. So where does that leave us? We really don't know yet. One thing that we do know is that storage bins are exempt if they're used in manufacturing. So if storage bins are tangible personal property for manufacturing, why are they not grain bins for purposes of real property? So that's an issue that will continue to rear its ugly head, but there are certainly positions for them being tangible personal property in the case you get audited for that particular issue. New law affecting manufacturers. touched on this. It exempts from sales tax machinery, equipment, replacement parts, and supplies used directly and primarily in manufacturing by manufacturers. So the new part of this is that supplies are exempt. Historically, supplies were taxable. This was your oils, your drill bits, your lubes, things that were used up very quickly. The question still remains, and I'll touch on this briefly, is what is a manufacturer? The jury is still out on whether a manufacturer can be a restaurant. 2010, the Supreme Court said, well, you don't have to be primarily a manufacturer, you just have to look at the piece of equipment. And if you think about it, a loaf of bread baked in a large factory, the oven is exempt there, but the loaf of bread baked in a bakery is the same bread, but according to the department, is not the baker is not a manufacturer and does not get that exemption. Like I said, the new rule rescinds the administrative rules that changed and redefined real and TPP, and the new rules say that storage bins are tangible personal property. I did want to touch on the manufacturing exemption. Last time we got some responses of, well, let's talk about, if you could talk about the manufacturing exemption a little bit more. So I'll do that here. I didn't put slides together, but I can talk about it. So the manufacturing exemption is really a door-to-door exemption. So what that means is when you bring in your raw materials, that's when your manufacturing process starts. So say you use a forklift to get the materials off of the truck, that forklift should be exempt. The machinery equipment you use to store the raw materials, that's exempt as well. Machinery and equipment used all the way through the process, that's obviously exempt as well. Replacement parts, supplies, exempt. And the manufacturing process ends when the finished product is shipped out of the manufacturing plant. So your forklift used to move the finished product is exempt, and the storage equipment used to store the finished product is also exempt. Services used in processing are exempt. So like I said, installation of new machinery equipment is exempt, and we are still trying to determine whether repair labor used on machinery equipment is exempt. We think it is, but the Department of Revenue does not agree with us on that issue as well. That should be resolved shortly, I hope. Another exemption is the fuel. So the fuel used for the forklift is exempt. The electricity used to power your machinery equipment is exempt. But the fuel or the electricity used to heat and cool the facility for comfort purposes is not exempt. So you have to distinguish between comfort heat and heat used to maintain the temperature of the facility. So, for example, your raw materials don't rust. That just gives you a little taste of the manufacturing exemption. All right. Going forward. So I tell you all this just to kind of give you a lay of the land. But there are some opportunities, or you may have thought of, oh, we don't have opportunities, we have threats here. But what can we do going forward? Tax refunds. If you think that, oh man, we maybe have overpaid some tax, you should file a tax refund. You have 3 years from the purchase date to file that refund, and I can certainly help you with evaluating your process to determine if you have a potential for a refund, and I can walk you through the refund process as well. Heavy equipment rental, we may want to stay away from that one given the new news of the Department of Revenue's audit audit activity, but that was very relevant the first time I gave this. Manufacturing machinery, that one's always a big one. Machinery and equipment can be a lot of dollars for a lot of folks. And recycling equipment, recycling is another exemption that's in there that has different parameters, but recycling has its own term. So if you think you're doing any sort of recycling, you get a refund on that. Tax liabilities, we can help you mitigate those. Failure to file a use tax return, that's your VDA. Contractor versus contractor, retailer, and online purchases, we can do VDAs for all of this. Process reviews, like I said, I can review your sales and use tax processes and tell you your holes, your risks, and how to implement strategies to mitigate these risks going forward. And then training. If you guys wanted a one-on-one training, I can come and do that as well. That's all I have. I do see a question here. Do you offer a longer, more in-depth seminar or webinar on this topic? I assume you're referring to manufacturing, and that goes right into my final shameless plugs of the day, which is our blog that's very, very focused on Iowa sales tax, Iowa income tax and property tax issues. It's called the Table Salt blog because we bring state and local tax salt expertise to the table. And then this goes into the webinar series. We're doing a webinar series, dates to be determined, on manufacturing sales and use tax, contractor sales and use tax. You guys may not want to sit through this one again, but you're certainly more than welcome to. Audits and appeals will be a third one, and Nexus in the wake of Wayfair. So Nexus is, do you have to charge sales tax, or do you have to pay income tax in states? And that all has to do with your physical footprint in the state. That may change after this United States Supreme Court decision, but I'm going to talk about Nexus and filing requirements and sales tax charging requirements, hopefully after that Supreme Court opinion is released. So to answer your question, yes, we offer in-depth seminars. I see another question here. I want more in-depth on the contractor tax topic. We can offer that if you give us, if you want to know, if you can pick a topic on, a couple topics that you want more in-depth on, certainly offer that. But, you can spend an hour on repairs versus new construction. So if you can send me an email and maybe I can put some bullet points together, or we can just talk. Feel free to give me a call, but I can certainly have more in depth. But that might be a 2-3 hour long webinar, and I'm not sure how many takers we would have for that. I think we've got 7 minutes left. Do we have any other questions? Okay. Here's my contact information, and there will be a poll at the end of this, and we may be sending you a SurveyMonkey questionnaire as well. And that SurveyMonkey questionnaire is helpful for us, so we can continue to give you more of these webinars, and it really helps us know whether this is beneficial or not. I think it's about a 3-minute survey. So if you get that, I would certainly appreciate your feedback. All right, thank you, and feel free to contact me with any questions.
Thanks so much, everyone, for staying online with us. This has actually been a really good topic for the industry, the ABC members. Feel free to contact Cody, as the information is still up on the screen. Give him a call, shoot him an email. Going forward, if you have any other questions about any of this, you can also contact me, and I can get you in contact with Cody as well. our ABC webinar series will continue next month. Just keep looking out for emails and look on our website for different topics that we'll be discussing. And most likely we will have Cody up here in the near future doing some other topics as well. So thanks so much for your time and have a good rest of your week. Oh, one more question from Vicki Jensen here.
I do not think the question was, are churches tax exempt? I'm going to caveat this with I'm not 100% sure, but I do not think they are on the list of designated exempt entities. I'll say that's 99% certain that they are not exempt. There are potential ways to structure around that, but I would need to know the facts and circumstances. So if you want the churches to be exempt, or if we want to know in depth how to structure the transaction so that they are, feel free to give me a call or an email. But to answer your question, no, they're not tax exempt. So the contractors must pay sales tax on the building materials for new construction.
Still got a few extra minutes if anyone else wants to get a question up there for Cody. All right, sounds like everyone is done with the questions. So we'll go ahead and sign off. Thanks so much for being online, and we'll talk soon. Thanks.